This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This is question Dexon. It's from June 2008. Obviously it's the question 2 in the F7 exam. In the Kaplan revision kit it's question 33, and again, I'm sorry you guys with BPP, I don't know what number it is in the BPP revision kit. Okay, quick read. Requirement first. Take into account any adjustments required by items 1 to 8. Oh dear. 8 paragraphs, that's unusual. It's normally not quite so many. Prepare a statement showing the recalculation of the profit for the year and a statement of changes in equity, and also a statement of the balance sheet at March X8, but no notes. It's what you can expect. I don't know what you think people think you should reasonably expect from this examiner and the questions you should expect. But question 1, I'll tell you what I've not done. I've not put the time up, so I'll carry on talking and then I'll put what time it is that I start Dexon. Question 1 is always going to be a consolidation question. Question 2 is traditionally, it's settled down now into preparation of financial statements, either from a trial balance or from what we have here with Dexon, a draft set of financial statements. Then question 3 is tending more and more to be prepare a report, but traditionally it was prepare a statement of cash flows, maybe with or sometimes without a report, but reports and financial analysis, ratio analysis, interpretation of accounts, that will be a question 3 type question. Question 4 is 50, sorry, those other 3 questions, 1, 2 and 3, those are worth 23 marks, 25 marks each. And question 4 is 15 marks and often has a numbers bit and a written bit. So it might be, for instance, provisions and contingencies, or construction contracts, or revenue recognition, leasing. It could be any of these sort of subsidiary IAS which themselves are not worth 25 mark question, but could sensibly be brought into a 15 mark question. And question 5 is a 10 mark question, and again it's the same sort of thing. It's a smaller, it's wrong to say less important IAS, they're all important, but it's not the sort of IAS question where you could make it into a 25 marker. So just 10 marks at the end now. Writing, there may be a little bit of writing in question 1, maybe 5 marks, part B, to discuss the advantages of consolidation, or discuss why directors may wish to exclude a subsidiary from the consolidation, that sort of thing, or define what is an associate, what's the significance of significant influence. That sort of question could be asked as a 5 marker in question 1. Question 2, we don't get many discussion wordy sections within question 2. There aren't many of them. It's just a preparation of financial statements, so I'd be very surprised to find a wordy subsidiary part of a question in question 2. Question 3 I've already just mentioned. Question 3 is quite a good chance of writing a report or analysis of figures or interpretation or ratio analysis. So question 3 would not be unusual to find quite a substantial part, maybe an entire 25 marks of report writing, or maybe it's a quick cash flow for say 9 or 10 marks, and then an interpretation of that cash flow for say 15 or 16 marks. Question 4 could very well be 5 marks written, 10 marks calculation, or even the other way around, 10 marks written and 5 marks calculation. And question 5 could be either a quick calculation or a quick bit of writing. But you do, of course, have 15 minutes at the start of the exam to read through, read the rubric, determine the rubric of the paper to see what's involved. And I'm just reading now this Dexon question to get back to Dexon, to where we started. We've got this requirement of preparing. So I'm going to put in the time of starting. The time to start is 12:10. Do I have the thing, my slider at the top of the page? I wonder, yes I do. So it's 12:10, and I've got 45 minutes to do this. Okay, well, as is the normal case, the figures themselves are not important at this stage. There's no point in looking at the draft statement of financial position. It's the notes to the question which are important. Just before I turn the page, just at the bottom of page 35 here, I can see that in the comprehensive income there's 8 million of revenue for credit sales made on sales or return. Well, I can deal with that one. I will deal with that, but then I'm on the second page. Okay, so point number 1. This is unusual. I would normally deal with point number 8 first, but I can see that point number 1 is only a quick one, so it's not going to be a particularly tricky one. Revenue includes 8 million on sales or return, and at the end of the year, presumably, at the end of the year, there were goods with still 2.6 million in the hands of customers. Well, if it's a sale or return, they're not actually a sale. It's only an achieved sale when the customer writes and says, oh, those goods that you sent me, I've managed to sell them, and here's the amount of money that I owe you. So if the goods on sale or return, they're not in fact a sale. They are therefore still our inventory, and we therefore need to reduce or reverse out. We need to reduce revenue by 2.6, and we need to reduce receivables by 2.6. And that gets them out of revenue, gets them out of receivables. I need to put them back into stock. So I'm going to increase inventory on the statement of financial position, and I'm going to decrease cost of sales and therefore increase the profits by the cost of these goods. They all had a markup of 30%. I'll go through the routine of this. Where we're talking about profits in terms of markups or gross profits, I always do cost plus profit equals selling price. It's a fact of life, you can't deny this, that if you put 30%, it's 30% profit. The question is it 30% of this or is it 30% of this? And if it's 30% of cost, that's called a markup. And if it's 30% of selling price, that's called gross profit or gross margin. So step 1 is always to put into this little equation, cost plus profit is selling price, always put in the percentage profit. And then look at the question. And the question says it's a markup, and so the cost figure must be the 100. It must be a 30% of cost, and therefore it's the profit element is 30 out of 130 of the selling price. And that fraction of 30 over 130 can now be applied to the 2.6 million, and it will give me the profit element is therefore 0.6, and therefore the cost is 2.6 minus 0.6 is 2 million. And that then gives me this adjustment: 2 million increase in inventory, 2 million decrease in the cost of sales, and therefore increase in the profit. So that deals with paragraph 1. Okay, now I'll turn the page and I've got all the other 7 points in front of me. I'm just trying to find my slider there. So I'm going to start with the point number 7. Sorry, point number 8. A dividend of 4 cents was paid in May, and then in November after the rights issue. So we've got a rights issue involved. I'm going to have to deal with paragraphs 7 and 8 together. I'll just take a quick drink of coffee. Okay, I'm going to have to deal with paragraph 7 and paragraph 8 together, because 8 is dependent upon 7. Fully subscribed rights issue of 1 share for every 4 at a price of 120. The proceeds of the issue have been received and the issue of the shares has been correctly accounted for. Well, I wonder why we've been told this. Oh, I see. Oh, look at that. We're given the information as at 31st March. And we're asked to do a statement of changes in equity. Look at these shares. The ordinary shares, I'm paragraph 7. The ordinary shares per the question are 250, but that's after a 1-for-4 rights issue. So the ordinary shares brought forward must have been 200, because I've then got a 1-for-4 rights issue, and that will give me an additional 50,000 shares. So I've got carry forward of 250, which is the information is given to me. So it's a sort of backward calculation, isn't it, where we need to find out what were the ordinary shares brought forward. If it's 250 after a 1-for-4, then it must have been 200 before. That's the shares, but we've also got the premium, haven't we? Because we've got these 50,000 new shares, and they are issued at a price of $1.20, and the face value is $1. The nominal value of the shares is $1. So I've got 50,000 new shares at a premium of 20 cents each. So I've got a 10,000 premium as well, and this is correctly accounted for share issue. Now, if I've got a 10,000 premium and I've got a closing figure of premium of 40, therefore it must have been an opening figure on the premium account of 30. Now, that's going to be needed when we get through to part B, prepare the statement of changes in equity. Alright, well that deals, I think, with paragraph 7. Paragraph 8 tells me about a dividend in May, and this share issue was September, so it's 4 cents per share on 200,000 shares, which is an 8,000 dividend, which was paid in May. And then we've got 3 cents per share on the increased number of shares, 250, that's 7,500 dividend paid. And dividends therefore paid of 15,500. Now that figure, 15,005, is going to appear within our statement of changes in equity. Because once we've worked out the profit for the year, or recalculated the restated profit for the year, out of that profit is going to be paid this 15,500, and that will appear not as an expense in the income statement, that will appear as an appropriation within the statement of changes in equity. So that deals with paragraph 8, and we've done 7. We can now do paragraph 6. Paragraph 6 is, it's the above figures do not include the estimate. So I'm going to have to do paragraph 5 and 6 together. During the year, the company's temporary taxable differences increased by 10, of which 6 related to the revaluation of property. The deferred tax relating to the remainder of the increase should be treated taken to comprehensive income. Applicable tax rate is 20. And then paragraph 6, the above figures do not include the estimated provision for income tax on the profit after allowing for the adjustments required in items 1 to 4. The directors have estimated the provision at 11.4, and this is in addition to the deferred tax. Okay. Now, again, I tend to do the tax adjustments, and they will be there, deferred tax and current tax. They will be there in question 2. They always are. And I can't emphasize enough that if you're going to take this exam easily in your stride, you have to be on top of these recurrent, guaranteed almost, elements within the questions. Question 1, the consolidation, has got guaranteed bits within it. Question 2, the preparation of financial statements. The tax is always in there, and it will be so reckless of you to go into the exam room not totally on top of these tax adjustments. If I look on the draft balance sheet, the draft statement of financial position, I've got a brought down figure per the question of 19,200, and this is the figure from last year. It says at 1st of April 2007, and I've got nothing for the current tax. There's no balance anywhere on the question for the current tax. So now I can go back to the paragraphs, the notes at the end of the question. During the year, company's taxable differences increased by 10. The tax rate is 20%. So 10 million and 20% is 2 million. So what we're saying is that this 19,200 needs to be 21,200, and there we have an increase of the 20% of 10 million, the temporary taxable temporary differences. And this is the 2 million which will fit in to balancing off the account. However, we're also told that this 2 million, some of it relates to revaluation and some relates to the temporary differences, remainder of the increases statement of comprehensive income. So to the revaluation reserve is going to go 6 million at 20%, which is 1.2, and to comprehensive income, but therefore I'm going to take it to current tax account, is the other 800, and that now balances that account. This 800 will go into the current tax account and double enters to the deferred tax. What I'm going to do is I'm going to do a revaluation account as well. Revaluation reserve from the question is 18,000 brought down, and this 1.2 is going to go to the revaluation reserve from the deferred tax account. And that's the effect of, that's the double entry for dealing with the deferred tax, which relates to a revaluation of property assets. Now I can work on the current tax. Paragraph 6. After allowing for the adjustments, the directors have estimated the provision at 11.4. They've estimated the provision. A provision is a liability of uncertain timing or amount, and it's there, 11.4. That's the liability. It's below the lines on the credit side, and it's been brought down from up here, carried down 11.4. And that's it. Ladies, gentlemen, that's it. This is 2 marks in any exam. There's 2 marks to get this tax right. So just let me balance this account off. That's 12.2, 12.2, 12.2 income statement. And that is got to be 2 of the easiest marks you will ever earn in any exam. I'm going to have another drink of coffee. Hang on. Right. So we've dealt with paragraph 5, 6, 7 and 8. Let's move on into paragraph 4. Oh, it's a long paragraph. It looks awkward, that. Okay, I'll leave it. I'll move on to paragraph 3. Investments at fair value through profit and loss are in a fund. 1st of April, we have an index of 1200, and we have a value, this was last year, of 12.5, and now the index held in a fund whose value changes directly in proportion to a specified index. The index has gone to 1296. So if 1200 is worth 12,500, what's the value of 1296? What's this dollar value? Well, I can take 12,500, divide it by 12 and multiply by 1296, and that gives me 13,500. And I can do it I can do it on the calculator, and everyone's happy. But if you're at all mathematically sharp, then you'll see that this has increased by 96. And 96 is a percentage of 12,000, is 8% of 1200, is 8%. That's an 8% increase from 1200 to 1296, and an 8% increase from 12,500 will give me 13,500. Doesn't matter how you do it. It doesn't matter whether you're sharp, you're quick, whether you're good with mental arithmetic, or you have to do everything on a calculator. But that's the basis of the point about this investments at fair value through profit and loss. It's an increase of 1,000 going through the profit and loss figure, the profit and loss account. Number 2, point number 2, and again I'm still leaving number 4 because number 4 looks awkward. Non-current assets have not yet been depreciated. We've got a policy of valuing land and buildings. Okay, land and buildings, let's sort them out. Land and buildings brought forward as 20,000 land and 165 for the buildings. That's brought forward. And we have a policy of valuing at the end of each year. And the values in the above statement, these values here, are at the brought forward position. These were at the start of the year, and their buildings had a remaining life of 15 years, and we've used them. So we've got depreciation this year, nothing for the land, of 1/15. That's 11. So now the carrying value at the end of the year is 20 and 154. And qualified surveyors valued them at 180, that's 170. So we've got a revaluation surplus to give me 180 according to the valuer. And finally, we've got plant. This is finally, before we get on to that difficult one, we've got the PPE, and it's on a reducing balance basis. And you know, in F7, Steve Scott will mix up the depreciation. Some depreciation is straight line, like we've just looked at with the building, and some other type of asset will be reducing balance. Just occasionally, it could be machine hour depreciation, or even some of the digits depreciation. He's done that as well. And some of the digits, if we come across the question, I'll show you some of the digits, but I'm not going to do it now. It's in the course notes how you do some of the digits depreciation. So the plant has got a value of 180,500, and it has to be reducing balance because it doesn't tell you what the cost is. So we don't know what the cost and the accumulated depreciation is. The only thing we can work on is 180,500, and it's on a 20% reducing balance basis. So 20% of that is 36,100, and that's that one done. Which means I can't avoid it any longer. I've got to look at paragraph 4. In late March, where are we? Okay, we're working to the year end of March, and just towards the end of the year, the directors discovered a material fraud. The company's credit controller. Incredible. I'm just looking at the equity. The equity, according to the question, 417 million. Total equity and liabilities is more than $500 million. You'd think, wouldn't you, that they could have and probably do employ an internal audit department and non-executive directors, and this credit controller has managed to perpetrate a fraud for $4 million. Now, $4 million itself in the context of the company is not excessive. Admittedly, it's more than the bank account is at the end of the year. The bank account is only 3.8. And the receivables of 52.2 include some of these sale or return. And even if I take those out, it's only 50 million. So 4 million is quite a slice. Anyway, that's by the by, mind is wandering. 4 million of the trade receivables was shown had in fact paid, and the money's been stolen. 1.5 had been stolen in the year to March 7. Last year, up until the end of last year, 1.5 had been stolen. It's not insured and it can't be recovered from the credit controller, and nor is it deductible for tax. So last year's profits need to be reduced. The brought forward figure last year was 12.3, and we've just discovered that 1.5 million has been stolen, so that actually needs to be restated to 10.8. This is a fundamental error. Prior year adjustment, we need to go back and restate that. So in fact, in the statement of changes in equity, part B, I'm going to say, as previously stated, 12.3, less prior year adjustment 1.5, as restated, it's 10.8. And then we've got another 2.5 million to reduce this year's profits. Okay, I think that's it. What I'm going to have to do now, and I should have been doing this as I went through the question, what I'm going to have to do now is go back. I've got my pen, I've got my question paper out, and I'm going to go through and make these adjustments on the face of my question paper. So I've got my revenues, my profit for the year is going to be down 2.6. I'm just writing this in the question paper. It's down 2.6. Receivables, where's my receivables gone? That's down 2.6. And my inventory and profit, my cost of sales is reduced by 2 million, and therefore my profit will increase by 2 million, and my inventory will increase by 2 million. Okay, that's that one done. What's that profit element? Okay, ordinary shares, they have been dealt with correctly, it says. And the dividend will have been dealt with correctly. So I've got the revaluation reserve. Oh, that changes, doesn't it? Because did we not revalue the asset? I think we revalued the asset, didn't we? Where are we? Asset. There, revaluation 6. So that's 22.8 carried down. I'm going to put that in the question. So 18 is plus 6 and minus 1.2. The current tax, I've got 12.2 to come off the profit figure, because that's the tax. And the deferred tax has got to be 21.2, so that's got to be plus 2. And the revaluation reserve, I've already written that down. Revaluation reserve, I've put minus 1.2 in my question paper. So keep going. Plus 1, so that's plus 1 on the profits and plus 1 on the investments. Land and buildings, we've got the depreciation, minus 11 in the profits, and land and buildings is minus 11 and plus 6, isn't it? The revaluation. Yeah, and the 36.1, so minus 36.1 depreciation and minus 36.1 for the plant. What's that one? No, that's the prior year adjustment. The retained earnings brought forward, that's minus 1.5 and minus 2.5 for this year. Oh, and the receivables, that's minus 4 as well, isn't it? Can't leave them there. They've paid. Okay. I think that should be it. So let's have a look then at the part A is the, what does it ask for? Recalculation. Recalc of profit figure. For the question, it's 96,700. Now I tend to have two columns here. I tend to have good news and bad news. Things which are going to improve the profit figure and things which are going to decrease the profit figure. I've got a minus 2.6. I'm looking at my question paper now. I've got these figures down. Minus 2.6, plus 2, minus 12.2. I don't know what they are, I can't remember. I have to go back and look at these. Plus 1, I know what that one is, I can remember that. 11,000 minus, that seems to be a depreciation, and 36.1 and 2.5. Okay, let's go back and think what these are. 2.6 is the revenue, and that's the inventory. 12.2, what was that? 12.2, do you remember? 12 is the tax. And that was the investment property. Was it investment property or investments? Investments. $11 was depreciation on the buildings. That was PPE depreciation, and 2.5 was the fraud. And that gives me the net profit after the dividend distributions. I need to add back the dividend, and that was, as I remember, I think that was 15, wasn't it? Oh dear, where's my slider there? Dividend, there, 15,005. So I need to add that back, because then in the statement of changes in equity, I'm then going to deduct it. Don't think I've missed anything. Let me just check again. I've got the 97. No, we'll have a look and see. That's 18,005. Good news. Bad news is 14, 20, 30, 40, 50, 60, 63, 64,400, I think. So I've got a net effect of 45,900. That's a net effect on this year's profits. Taken off, then that's a negative as well. So that gives me 50,800, I think. Profit for the year, 50,800 adjusted. I don't know if it's right, but I'm going to carry on. Prepare the statement of changes in equity. Yeah, we can do that. Statement of changes in equity is made up of shares, premium, revaluation. There's no separate equity element in terms of compound financial instruments. Retained earnings and a total. And we've got brought forward figures, and brought forward shares, I think we decided were 200,000. Brought forward premium was 30,000. Brought forward revaluation we know is 18,000. Brought forward 12,300 retained earnings, and that gives me 248, 250, 260,300. But we've got the prior year adjustment of 1.5. That gives me 10.8 as restated. 258,800. Now I suppose technically I ought to be putting these figures in as well, but I'm not going to. Right, this year's profits. We said were, what's the figure? 50,800. Out of which a dividend has been paid of 15,005. Then we had the share issue of 50,000 at a premium of 10,000. We've got revaluation this year at 6,000, but it was 6,000 minus 1.2 deferred tax, wasn't it? So it's 4.8. Carry that through, that's 60,000. 4.8. Was there anything else? Don't think there was anything else. Let's do this. 250,000. If there was, then we'll find it when we do the statement of financial position. 22,800. 35, 45, 46,100. Tell me if I'm wrong. You check my calcs, will you? 16, 11, 19. Carry 1, 9, 4, 8. 5, 10, 15. 358, 900. 900 is right. 46, 68, 108, 358. Well, that looks cross adds it okay. But I may have forgotten something. Statement of financial position. Land and buildings. We're told that it was 185 minus 11 depreciation plus 6, so it's 180, and that's what the question told us. PPE, it was 180,500 minus the depreciation of 36.1, 144,400. Investments is 13,500. I've just stopped there just to think, did I deal with that 1,000? I did, didn't I? Yes, it's there. And that's it for long-term assets, 337,900. Current assets, I've got inventory, which was 84, but I've added back the 2, so that gives me 86,000. Receivables are 52.2 minus the 4 and minus the 2.6 on sale or return. So that's 6.6 coming off there, which is 45.6, I think. Again, you check my ads. Bank is 3.8 according to the question, no adjustment. 1523 to 23 to 17, 473.3. Shares have been dealt with correctly, 250,000. Premium, 40,000. None of that has changed, or it has correctly been changed. Revaluation is 18 minus 6 plus 6. I've written minus 6 in my question. It's plus 6 minus 1.2. That's 22,800. I've written minus 6 on my question paper. In fact, I'm going to change that, because if I ever look at that again, I'll be confused. Retained earnings. Now, I'm going to cheat here. I'm just going to go back up to the statement of changes in equity. 46,001, and hope that that's right. There's nothing else, so 358,900. Long-term liabilities, I've got the deferred tax, and that was 21,002. So 380,100. Current liabilities 81,008, but I've also got the tax, and the tax was, and you know, I've not written that in my question paper. I was lucky to remember that. Tax 11.4. I was lucky to remember that. I'm going to write it in now. 11 point. That's for my benefit, not for yours. 11.4. 11.4, that's 93.2, I think, 93,200, 473,300. Do I have any other current liabilities? 473,300, it balances. Great. Have I finished? Yeah, I have finished. The time is 12:43. Let's just go back up to the top. 12:43, 33 minutes. I'm feeling pretty pleased with myself, but it's not fair, because as a qualified person who's been teaching for a number of years, it's not fair that I should be feeling big-headed about it. I still get a big kick when I do balance a question. I still get a big kick out of it, and I do my best not to look at the answers, and so whenever I do balance a balance sheet, it's a positive achievement. And to do it in 33 minutes, well, this is not in any way trying to show off. It is more an indication of the fact that if you can get yourself into a position where you are familiar with the way that Steve Scott sets these questions out, and what are the recurrent themes that come through in his questions every session. The tax comes through, the bank is often an overdraft, there's often an issue of shares or a dividend partway through the year, or a loan is borrowed partway through the year, and the face rate of interest is different from the effective rate of interest. There will always be a depreciation calculation. There'll always be two different types of calculation. One will be reducing balance, the other will be straight line, and there may in fact be a third and even a fourth way of depreciating. It depends how difficult or how complicated he wants to make the tangible non-current asset note. But if you can get yourself, and just repeat it, if you can get yourself into the situation where you're not fazed by any question that he asks, and even if you are, even if you've not seen it before, like that paragraph 4, in late March 2008, the directors discover a fraud and it's got an effect on the previous year. And even if you come across something like that, the technique surely is not to get stuck on that one particular element when there are all the other elements which have got the available easy marks within them. So I think we should be able to, you should be able to, I'm not going to be doing the exam, but you should be able to get on top of these items, these matters, and kill it and get rid of F7. And another thing about getting rid of F7 comfortably is that P2 is a big step up. P2, the Advanced Corporate Reporting, is a big step up from F7, and it would be really good if you could get yourselves a solid base of effectively double entry bookkeeping, isn't it? And knowing how to deal with things in financial statements. Because if you can get yourself a solid grounding at this level, then this will be advantageous when you get to the next level of P2.